A Cayman Island shell trap. A retail-driven casino. You are just buying a worthless piece of paper. Listen to those words. Let them ring in your ears for a second. These are not the random ramblings of internet trolls. These are the exact phrases, the literal verbatim quotes, dominating the private wealth management floors in Manhattan, echoing through the Reddit forums of retail traders, and filling up the X timelines of financial pundits right now. This is the collective intellectual consensus of Western capital in the year 2026. The overriding narrative is that allocating capital to Chinese technology is akin to building a house on quicksand. It is viewed as an absolute nightmare of delisting risks, regulatory black boxes, and data decoupling. The verdict has been handed down by the high priests of finance. It is uninvestable. But while Wall Street is paralyzed by this geopolitical fear, while retail investors are being told to run for the hills because of the variable interest entity structure, a massive, silent, and ruthless reallocation of wealth is happening right under their noses. I am talking about a fundamental mirror effect in the capital markets. As Western funds retreat, terrified by the shadows of their own media narratives, the sharpest, most ruthless apex predators in the East, the Chinese billionaires, the industrial titans, the sovereign wealth apparatus, are quietly executing the largest infrastructural land grab of the 21st century. Why is the very asset class that Wall Street considers a toxic poison pill currently being hoarded by the smartest money in Asia? What exactly do these billionaires see that the analysts in New York are entirely blind to? You have been conditioned to look at investing through a very specific, very Western lens. You look for the software disruptor. You look for the asset-light SaaS company that can scale with zero marginal cost while ignoring the regulatory environment until the regulators finally wake up. You look at China and you see a government that cracked down on consumer internet companies, and your immediate instinct, driven by sheer panic, is to label the entire market a command economy wasteland. You are told it is a retail casino where fundamentals do not matter. I completely understand why you are terrified. If all you read are the surface-level headlines about export curbs, rare earth divides, and tariff wars, walking away seems like the only logical fiduciary duty. You have been sold an illusion. The illusion is that heavy-handed government policy destroys value. But here is the reality that is going to make you very uncomfortable. You are fundamentally misunderstanding how wealth is generated in the next iteration of the global economy. You are confusing a shift in regulatory priorities with the destruction of capital. What you view as a restrictive, authoritarian crackdown, the smart money views as the forceful creation of a system-level efficiency. Wall Street is obsessing over the lack of unregulated disruption, while Chinese billionaires are aggressively buying into state-selected infrastructure monopolies. They are buying the rule makers. They are buying the very foundation of the new economy. Chapter 1. State-sponsored Derisking. Let us tear apart the first massive blind spot, the low-altitude economy, or what the West casually dismisses as the flying car pipe dream. If you ask an American venture capitalist about electric vertical takeoff and landing aircraft, or eVTOLs, they will tell you it is a cool concept that will bleed billions of dollars in research and development and spend a decade dying in the bureaucratic purgatory of the Federal Aviation Administration. And they would be right, if they were talking about the United States or Europe. The FAA and the European Union Aviation Safety Agency, EASA, are currently projecting a timeline of 5 to 7 agonizing years just to finalize the airworthiness certification standards for these vehicles. 5 to 7 years of burning runway, paying compliance lawyers, and waiting for a rubber stamp. Now look at what just happened in China. The Civil Aviation Administration of China, the CAAC, did not spend 7 years debating theoretical safety models. They executed what we call a regulatory sandbox strategy. They pushed the legislation through, they partnered with the leading domestic players, and they completed the eVTOL airworthiness certification in exactly 31 months. 31 months. Let that sink in. This is not just a neat little administrative victory. This is a brutal dimensional strike on global capital efficiency. While Western competitors are trapped in regulatory limbo, Chinese companies are already accumulating thousands of hours of real-world commercial flight data. They are iterating their hardware based on actual passenger logistics, not computer simulations. This is exactly why He Xiaopeng, the billionaire founder of Xpeng Motors, just successfully raised $500 million, $500 million, specifically for his flying car unit, and is aggressively accelerating its IPO timeline in Hong Kong. He is not gambling on a consumer fad. He is securing a monopolistic chokehold on a sector that the state has explicitly designated as a strategic growth engine. He knows that the 31-month certification timeline is a state-backed moat that no Western competitor can cross. When the government acts as your primary derisking agent, when the state machine itself guarantees the certainty of the emerging track, your investment is no longer a venture capital bet. It becomes a utility-grade infrastructure play. Wall Street calls it a risky bet on a Chinese tech stock. The billionaires know they are buying a toll booth on the sky. Chapter 2. Systemic Cost Suppression. But if you think the low-altitude economy is a paradigm shift, you need to brace yourself for what is happening with artificial intelligence infrastructure. This is where the Western narrative is not just wrong, it is dangerously obsolete. The West views AI through the lens of extreme capital expenditure. We look at the trillions of dollars needed to build out data centers, we look at the immense power consumption, and we worry about an AI bubble. We see AI as an unbelievably expensive laboratory experiment that might eventually yield productivity gains. China has a fundamentally different philosophy. They are treating data not as a byproduct of software, but as the fifth factor of production, standing right alongside land, labor, capital, and technology. They are not waiting for private enterprises to slowly piece together localized server farms. They are constructing a national integrated computing network. They are executing a violent aesthetic of infrastructure building, treating compute the same way they treated high-speed rail and electrical grids 20 years ago. The numbers are staggering, and they are moving faster than the models can update. In 2025 alone, China's intelligent computing power supply exploded, surging by an unprecedented 87.6%. By the middle of 2025, their intelligent computing scale hit a massive 788 EFLOPS. This represents an almost 8-fold exponential leap from the end of 2024. They are aggressively marching toward a target of breaking 300 EFLOPS in core intelligent compute milestones, while total capacity goes parabolic. And they are backing this up with sovereign capital on a scale that breaks the human mind. National-level investment funds have injected an almost unfathomable $912 billion into strategic AI architecture over the past decade. Nearly $1 trillion of unyielding, patient capital designed solely to drag the cost of compute down to zero. Why does this matter? Why should you, an investor sitting in London or New York or Singapore, care about China's EFLOPS count? Because this state-driven integration is turning artificial intelligence from a luxury good into a cheap, universal public utility. This is the exact reason why a small Chinese team could release an open-source model like DeepSeek and send shockwaves through Western markets. Wall Street analysts tore their hair out trying to understand how DeepSeek could claim training costs of barely $6 million, while Western giants are burning billions. The answer is not just algorithmic efficiency. The answer is that they are operating on top of a nationalized, heavily subsidized, highly optimized compute and power grid that responds with lightning speed. They are leveraging the east-to-west computing resource transfer project to access dirt-cheap energy, entirely bypassing the bottleneck of power constraints that is currently choking Silicon Valley. This is a structural, system-level suppression of costs. It is a dimensional strike against the expensive, fragmented AI R&D systems of the West. When you understand this, The actions of the Chinese billionaires finally make terrifying sense. Lei Jun of Xiaomi, He Xiaopeng, Wang Tao of DJI, they are not throwing money at these sectors because they are hoping for a quick speculative pop. They are taking defensive, deeply entrenched positions in the foundational layer of the next industrial revolution. They are locking up the grid. They are buying the track before the train has even been built. Chapter 3. Sovereign Arbitrage. So, where does that leave you? What is the smart money framework for the investor who wants to strip away the geopolitical noise and actually generate alpha? You have to recognize the deep structural mismatch in logic between the East and the West. When an American hedge fund manager looks for a growth stock, they want a company that can evade regulation long enough to achieve monopoly scale. They want the Uber model: move fast, break things, and settle with the regulators later. When a Chinese billionaire deploys capital, they look for the exact opposite. They want the company that is actively writing the regulations in partnership with the state. They want the company whose business model is explicitly underwritten by the National Development and Reform Commission. Ask yourself this: would you rather invest in an incredibly innovative Western startup that has to fight tooth and nail against a slow, antagonistic regulatory body for the next decade? Or would you rather invest in a heavily scrutinized Chinese infrastructure play that has a clear, state-mandated monopoly, access to near-infinite subsidized computing power, and a regulatory sandbox designed explicitly to guarantee its rapid commercialization? This is the arbitrage of the century. It is an arbitrage of perception versus reality. A few hyper-aware Western institutions are already quietly changing their tune. If you look closely, firms like Ruffer, UBS, and Goldman Sachs are beginning to aggressively build contrarian positions. They are looking at the vast valuation discounts, the so-called fear premium, attached to Chinese hard tech and AI infrastructure, and they are backing up the truck. They are listening to analysts at Gavacal who correctly point out that Chinese industrial deflation is not a crisis. It is a massive global dividend for those positioned correctly. They realize that the moat surrounding these Chinese tech giants is infinitely deeper than Wall Street's fragile models ever predicted. Wall Street is terrified that the Cayman Island FIFIE structure means they are buying a worthless piece of paper. The smart money knows that the paper represents a legally enforceable, state-backed claim on the most efficient technological infrastructure ever built by human hands. You do not have to like the system. You do not have to agree with the politics. But if your job is to allocate capital and generate returns, ignoring a systemic, state-sponsored leap in industrial productivity out of sheer ideological stubbornness is financial suicide. The low-altitude economy and the national computing network are not speculative gambles. They are the new baseline utilities of the Eastern Hemisphere. The billions of dollars flowing into these sectors from domestic titans are not bets on a casino wheel. They are the concrete being poured into the foundation of a new economic paradigm. You can continue to trade off the fear-mongering headlines. You can continue to believe the illusion that the entire market is uninvestable. Or you can wake up, study the actual flow of smart, sovereign-backed capital, and realize that the greatest generational wealth transfer is happening right now in the very assets you have been told to fear the most. Understand the underlying logic of the asset, ignore the hysterical noise of the crowd, and position yourself where the real gravity of capital is pulling. If you want to stop getting played by the mainstream financial narrative and start front-running the smartest money on earth, subscribe to the channel. Would you like me to analyze any specific companies operating within this new infrastructure framework for our next deep dive?